The federal budget will be released in just a few hours' time. Treasurer Jim Chalmers this morning says we can expect a surplus of $9.3 billion, but the deficits will blow out in the coming years due to what he calls unavoidable spending. Well, joining me now is KPMG Chief Economist Mr Rynne. Brendan, thanks for your time.
That's right. Forecast
surplus of $9.3 billion, but that looks good, but it's the coming years, the forwards estimates, where things start to look a bit grim.
Yes, and so that's not surprising. I mean, we've had a forecast budget deficit in terms of a structural budget balance for a long time, and it's now just catching up with us. What we're seeing is that some of the revenue benefits that we've got from very high employment, strong commodity prices are starting to run out of steam, and so that those tax receipts won't be strong enough to be able to cover the forecast spending that the government plans over the medium term.
Looking at this current financial year with the surplus of $9.3 billion, you say a lot of it is that strong employment market and pretty good prices for iron ore and coal and things like that.
Yeah, and you also have to remember that the budget's predicated on basically an immediate hollow log with regards to commodity prices. It always forecasts an iron ore price. Last year it was $66 a tonne. It's consistently been above 100. So the marginal price difference feeds all the way into higher company profits straight away.
There are some big ticket spending items we're already aware of: NDIS, defence, aged care and health.
Yes.
I guess that's just going to add to that spending and deficits in the years ahead.
Of course, but that's exactly what you want government to be doing. You want government to be looking after the population in those parts of the economy that the market doesn't. The issue, though, of course, is trying to ensure that all that spending's efficient and that spending's matched by revenue. And what we haven't seen in the budget, or not anticipating to see in the budget, is any wholesale tax reform that's going to allow those budget deficits to come back closer to a surplus or a balance over time.
Yeah, the fact is NDIS, defence, aged care, health, these are all super important things, and obviously they cost more and more money each year.
Yes.
But yeah, so how does the government boost its revenue in the coming years then?
Well, simply I think what it needs to do is a combination of having more efficient taxes, looking to reduce our reliance on income taxes, both personal income taxes and company income taxes, and increase more efficient taxes like GST. What we know, however, is that the conversation around tax reform is just political suicide. Combined with that is that we do need government spending to be much more efficient and making sure that all the elements of the budget are really spending on public need.
This morning, we've seen comments from Warwick McKibben, the former RBA board member, claiming the reduction in inflation that the Treasury's forecasting is a political trick. It's basically handouts. That's not going to reduce underlying inflation. That's his argument. What do you think about that?
Oh, look, I wouldn't call it a political trick, but what it is that we know that how they do the energy subsidy is it comes off the cost before it comes into the price for consumers. So what you see is a reduction in the index value for that component of the CPI. And whenever that subsidy is going to run out, that index value will kick back up and you'll get a spike in inflation in energy prices in that quarter when those energy subsidy stops being provided.
And speaking of inflation, the Reserve Bank has a forecast of 3.8% true mean by the end of this year. Treasury is quite a bit lower. They think the RBA is going to get to its target band by Christmas.
Yes.
What's the discrepancy there?
Look, I don't know. It's difficult to say what the driver of that inflation is. Clearly, there's two different expectations by the macroeconomists in Treasury than there are in the Reserve Bank. I myself think it's probably going to be somewhere in between. I think that the Treasury forecasts, and I was thinking they're quoting numbers of 2.75%, just seem too strong in terms of the drop down to where we are, whereas the Reserve Bank has the inflation bouncing back up. We know that services inflation still remaining strong. We're going to see wages growth coming through the Fair Work Commission, not as much as last year, but probably in the 4% band. That means that services inflation is still going to be pretty sticky, but the trajectory still should be downwards with the tight spending by households elsewhere. But I don't expect it to be as optimistic as what the Treasurer is forecasting.
Mr Rynne from KPMG, thanks for your time.
Thank you.